Thailand stands out in Southeast Asia as the only middle-income nation where the military repeatedly intervenes in politics. Since the monarchy's absolute power ended in 1932, the country has seen around a dozen coups, 2 of them within the past 2 decades. Mass demonstrations have continued since early 2020, with major waves between 2020 and 2021 and smaller rallies still appearing in 2025. Yet despite the turbulence, millions continue to visit the country every year. Nearly 35 million travelers arrived last year alone, drawn by its beaches, nightlife, and warm climate. Political upheavals have never stopped Thailand from reshaping itself from a farming-based society into a modern industrial economy. Between 1982 and the Asian financial crash of 1997 to 98, the country grew at an extraordinary pace, close to double digits. But after the 2014 military takeover, growth slowed sharply. Southeast Asia's second-largest economy has expanded at only 2.5% annually, barely half the pace of neighboring ASEAN nations. Investor sentiment has weakened too. Thailand's stock market has fallen to lows not seen since March 2020, dropping nearly 23%, the worst performer among major global indices. The question many are now asking is, what derailed Thailand's long-running economic success? Historically, what set Thailand apart was its unique position as the only Southeast Asian nation never fully colonized. By sitting between the British and French empires, the country acted as a geopolitical buffer, a role that allowed it to stay autonomous and become a natural trading hub. After the Suez Canal opened, this advantage grew even stronger. Thailand rose to become a leading rice exporter, a status it still maintains, although much of the early economic gains were controlled by technocrats and spread slowly across the population. Modern Thailand's economic structure truly started taking form in the mid-1980s. Even though it wasn't part of the Plaza Accord, the country was deeply affected by it. Because the Thai baht was pegged to the US dollar, the agreement made Japanese goods more expensive worldwide. Seeking cheaper production, Japanese companies began relocating manufacturing to Thailand, which sat at a crucial junction between the South China Sea and the Malacca Strait, one of the world's busiest shipping routes. Thailand responded by loosening regulations, inviting foreign capital, and transforming itself from a farming-focused economy into one that exported competitively priced manufactured goods. As factories multiplied, agriculture also modernized. Mechanization replaced manual labor, allowing many workers to move into higher-paying industrial jobs. This export-driven boom powered the country for years, right up until the financial crash of the late 1990s. Though growth slowed afterwards, foreign investment continued flowing in. The currency peg reduced exchange rate risks, making Thailand a dependable base for global manufacturers. And even during difficult periods, rice exports provided steady income. Because rice is an inelastic product, demand remains stable even when prices change. Neighbors like Indonesia and the Philippines continued buying it in large volumes. Recently, however, Thailand's exports have taken a hit. Reuters reports that total rice shipments have plunged 36% since their 2017 high. The reasons are complex. Tougher competition from Vietnam and India, reduced demand from key buyers, unpredictable currency swings, and the lingering effects of earlier U.S. tariffs on products like autos and agricultural goods. For decades, Thailand was a regional manufacturing powerhouse, especially in autos. It merged Japanese car-making expertise with a dense network of Thai parts suppliers and became Southeast Asia's top vehicle producer. Today, the assembly lines are much quieter. Annual car production fell to 1.5 million units in 2024, down 8% from 2023 and nearly 40% below peak levels from a decade ago. Low labor costs once made Thailand the ideal place for factories, but neighboring countries like Vietnam are now cheaper. Even Japanese giants like Suzuki and Subaru are shutting down Thai plants. Electric vehicles built by Chinese companies inside Thailand have also disrupted the auto sector, displacing Japanese brands that traditionally relied more heavily on local parts makers. But the deeper issue goes beyond competition. Household debt has ballooned. Since the Thai government introduced tax breaks for first-time home and car buyers in 2011, household debt has climbed to 92% of GDP, almost as high as the US before the 2007 financial crisis. This pressure on families has dragged down overall consumption. With so much income going toward repayments, people are cutting back on big purchases, which has caused consumer confidence to drop for 6 straight months. Private spending, the backbone of domestic growth, is slowing sharply. These financial pressures come at a time when Thailand is experiencing a major demographic shift. The population is aging rapidly, and birth rates have fallen below European levels. By 2024, Thailand's fertility rate is around 1.3 children per woman, placing it among the world's most rapidly aging societies. The challenge is made worse by the fact that most elderly citizens lack savings. Roughly 80% depend on financial support from their children. This demographic decline traces back to successful family planning campaigns of the 1970s. Through slogans such as "more children means more poverty," the government encouraged smaller families. The strategy dramatically lowered birth rates, from roughly 1 million births a year in the 1960s and 70s to far fewer today. While the original program achieved its goal, new factors, higher education levels, rising living costs, and career-focused lifestyles now continue to suppress birth rates. Another major problem is Thailand's unusually low inflation rate. Consumer prices have fallen by about 0.79%, and core inflation has stayed below the central bank's target for nearly a decade. Low inflation may sound harmless, but it signals weak demand. Businesses cannot raise prices, landlords struggle to increase rent, and wages remain stagnant. With incomes flat and costs not rising, the economic engine slows down. This creates a dangerous risk: deflation. Japan fell into a severe deflationary cycle after its 1990s financial crash, and Thailand now faces similar warning signs. When consumers expect prices to remain low or drop further, they hold on to their money. As spending slows, companies cut production, freeze wages, and sometimes lower prices even more, fueling the cycle. Some pressures come from cheap imports. Low-cost Chinese goods pouring into the Thai market have pushed prices down and made it harder for local manufacturers to survive. This structural problem cannot be fixed by interest rate cuts alone. Stronger policies, such as anti-dumping measures or targeted industrial support, are required. Beyond internal issues, Thailand's long-term position in global markets is also uncertain. The country carries high political risks, but offers relatively low economic returns. Traditional export sectors, which make up 2/3 of its GDP, are losing competitiveness. For example, Thailand produces most of the world's hard disk drives, an industry rapidly being replaced by SSD technology. Efforts to pivot toward advanced manufacturing, including semiconductors, are still in early stages. Meanwhile, regional rivals like Vietnam and Malaysia have already secured head starts by attracting more high-tech investment. Unless Thailand quickly shifts toward future-oriented industries, its economic challenges will continue to intensify.